What's up, YouTube? It is Kevin. Welcome to another exciting episode of Tesla Today. So it came out, it's true, S&P 500 inclusion all at one time, December 21st. That's when the dump truck's going to back up the S&P 500 and unload $80 billion into buying Tesla stock. That's a lot of firepower going to one stock on one day. Of course, there's going to be front running. They don't have to buy all the stock that day. It's just an order from the S&P committee to all of the fund managers out there that track the S&P 500. You must have and include Tesla, which will make a little bit of a weight of about 1.3% overall of the S&P 500. And they're going to have to buy those, whatever it is, an outstanding float of 120 million shares over the next 3-4 weeks. They don't have to buy, exactly on December 21st. They can buy, my understanding is they can buy 4 weeks ahead of it, 4 weeks behind it, but plus or minus 4 weeks of that inclusion date, and that's when those shares have to happen. We saw what Tesla did today, hit an all-time high intraday of like $606 a share, and then it took some slide off, some weakness. Of course, Nikola finally bit the dust. GM kicked them to the curb. I think Trevor Milton was probably the smartest one to bail out and take that money and run with his Nikola Motors. So who knows what the future the Badger has. I think it slid like $6 or $7 down to like $21 a share. Meanwhile, Tesla ended up closing at $567 and change today. After hours, it went for a run up all the way back up to $590. We're going to see some of this implied volatility, folks, over the next few weeks. Once again, we're 3 weeks away from that mandated S&P 500 inclusion for Tesla. They'll go in the 5th or 6th largest position of a company out of the 500 companies that actually make up the S&P 500. Tesla is the largest company to ever be included in the S&P 500, which is going to cost a lot more short-term pain, more money for those fund managers that want to go into Tesla, because many stockholders like me, retail investors like you, us, we're not just going to get rid of our shares. We value our shares. We worked hard and invested our money into these shares. Some of us are going to go, you know what? I'm only 35 years old. I don't care what they're doing. I'm going to hold on to Tesla for the next 10 to 15 years. That's my retirement. That's fantastic. Me, I'm a little bit different. I'm 49. I'm trading a tax-deferred account. I do believe there will be a run-up into the S&P 500 inclusion. And then after inclusion, I do believe there will be a pullback. How significant that pullback? We'll see. Depends on a few things, right? I think Elon just recently tweeted that he's looking at increasing the spread of the full self-driving or FSD beta out to more people, hopefully to the masses, within 2 weeks. Well, that's be about December 14th. It'd be about 2 weeks from today if he does that, or about a week prior to the inclusion in the S&P 500. That can be a support to keep the Tesla stock price up higher. Plus, any unknown news, right? I think you got a couple of catalysts on the other side of that play, and we're looking both at the bull and at the bear stuff we're going to now show some analysis with today. We have to gather as much information as possible to evaluate and come to our own logical opinions on what we believe in with our investing knowledge and our investing style. It's to each and every one of us to do that, and that's what I'm providing here for you today. So let's listen to what some bears think about what's going to happen with the Tesla stock.
Hello and welcome. This is Sean Cornell of Cornell Capital Group. Today we will be valuing Tesla. I thought it would be a good time to do this considering it was just recently announced that Tesla will be joining the S&P 500. And they had also just recently broken the 500 billion mark in market cap. And Tesla has always been a hotly debated company, now so more than ever, with passionate viewpoints on both sides. So here at Cornell Capital Group, and in order to bring some clarity and kind of remove some of the emotion.
Remove some emotion? I don't think that's going to be a problem for him.
We will be conducting a discounted cash flow analysis on Tesla.
Discounted cash flow. Spoiler alert, I bet he uses the discounted cash flow, or DCF. Just take a stock price and then work it backwards and only evaluate Tesla as simply an auto company just like Ford or GM. Nothing about technology, nothing about full self-driving, nothing about solar, energy, Tesla insurance, anything at all going forward, robotaxis or the like, strictly as a car company. Let's see if I'm right.
And before we jump into the model, here's Andrew with some background and summary.
Yeah, thanks, John. I thought things had finally settled down with Tesla since early September. The stock, had been relatively flat, trading at that $400 level through most of September and October. In fact, even the earnings announcement in October didn't significantly move the stock all that much. Of course, that all changes November 16th when we get the announcement that Tesla was added to the S&P 500. And since the 16th, we've had yet another wild Tesla ride. Stock has gone from 400 to over 600, a 45% increase in less than 2 weeks. And it's times like this when I think it's all the more important to remind investors that there are still underlying fundamentals for Tesla that are important, and they often get ignored, in high momentum periods like this. So let's take a look at some of these. Start with vehicles sold. I think this is important because it gives you a good sense of the scale of Tesla's competition. And GM, Volkswagen, Toyota, three of the biggest automakers in the world. And as you can see, they sell significantly more units than Tesla does. And not surprisingly, we get a similar picture with revenue, 30 billion versus 137, 250, and 272 billion for the other three. Now, you would think, given the size of these companies, you wouldn't expect market cap to look like this. And with Tesla at 555 billion, they are significantly larger than any of the other three. Toyota at the moment is the second largest automaker in market cap, and as you can see, it's still more than half of what Tesla is. So given the high market cap and the low level of production, what are Tesla's plans to close the gap here? Obviously, to justify this kind of market cap, Tesla has to show growth. There's no question about that. So what is Tesla's plan for growth in the future? Well, let's start with the factories. At the moment, Tesla has a factory, their main factory in Fremont, California, and that should produce roughly 600,000 if all things go well, produce 600,000 cars this year. Same with Shanghai. If production stays at the rate they're planning, they should have 200,000 cars this year. Now, they've only got two more factories on being built at the moment. So with the factory in Germany coming online in 2021 and Texas in maybe 2022 or 2023, we've got a situation where 3 to 4 years from now, Tesla could possibly be producing 1.5 million cars. Now, that's impressive growth on a percentage basis, but when you consider 1.5 million is still far less than the 29 million cars that GM and Toyota and Volkswagen are producing today. And they're still valued at 2/3 of what Tesla is. So Tesla has a lot of growing to do. And, remains to be seen if these 4 factories will be enough growth for investors to justify such a high value at the moment. Thanks.
Thanks, Andrew. Okay, let's dig into the DCF model. At the top here, we have all the financials entered in for Tesla. But down here where these colored cells are is where we are going to do most of the work and tell our story for Tesla. And I encourage, we'll have this spreadsheet available to download, and I encourage you to download it yourself and tell your own story. Play with these numbers and the assumptions and see what you get. So in this model, I've made 3 cases: a base case, bear case, and a bull case. And so let's start with this base case. For revenue growth for next year, year 2, and year 3 to 5, I've given Tesla a 25% growth rate, which is very generous for an automobile manufacturer. And this is a highly growing company, even in this base case. And same with operating margins. The operating margins for the auto and truck sector, are around 5%. It's a capital intensive, low margin business. And again, we've given Tesla quite a bit more, an operating margin of 12% next year and going forward into the future. Here we have our sales to capital ratio, and this is used to compute the reinvestment. It basically is a measure of how efficiently a company uses its capital. And again, even for the base case, I've been generous to Tesla, giving it a 2.5 sales to capital ratio versus the overall sector of 1.06. And finally here, we have our perpetuity growth rate in the terminal year: 1 base, 2 bear, and 3 bull. So for our base case, we are getting a value per share of $144.71. That's versus the close price on Friday of $585. So quite a bit below that. And those were, again, using fairly optimistic and generous assumptions to Tesla. Our bear case, only $72. And now let's get to our bull case, which had the rapidly growing numbers in the near term and the operating margin of 16%, which is the best in the industry. And we're still only get to 301, just over 300. So, almost half of what the price is. So you might ask, what would it take? What is the market thinking? What would it take to get to that price? What would we need to have? So let's see. You would need 50% growth for next year, 52% growth for year 2, and a 30% growth rate from years 3 to 5. Also, I'm bumping up the operating margins to 20% next year and going forward into the future. They can maintain. This is unheard of in the auto industry.
What does Elon think about this bear case scenario? And on the flip side, on the bull case, we actually had a price increase today. Here it is. Okay, and then finally we have a price increase for Teslas from CFRA. Raises the Tesla price target to $650. It sees momentum continuing. Well, it doesn't take a rocket scientist to make that call, does it? Tesla stock has been on a dramatic rise since the announcement that the company will be included in the S&P 500. The increase in share price is due to anticipation that funds will need to buy a large amount of shares come December 21st. We already talked about that, about 120 million of the actual float out there. On Monday, the CFRA analyst Garrett Nelson, whoever that is, maintained a strong buy rating on Tesla and raised the stock's price from $550 a share up to $650 a share. Nelson thinks Tesla's positive moment from the S&P inclusion announcements will continue. Or I should say, it should be not moment, it should be momentum, right? Who edits this stuff? He also mentions the possibility of electric vehicles being subsidized under the Biden administration, which we are already anticipating, right? And then Nelson previously suggests selling Tesla shares in January 2020, calling out the valuation company at the time quite frothy. I like me a frothy. Tesla trades around $586 per share at the publication time. The stock's now higher by 600% year to date, which is pretty fantastic. Then you show the latest ratings for Tesla back in November 2020. Webbush with Dan Ives did an action of maintaining to neutral. Of course, Morgan Stanley, Adam Jonas, as we know, did an upgrade from equal weight to overweight, which is great for the stock. Adam's always been a bear on Tesla. He's finally coming around, like I said, to a semi-bull now in Tesla. And then finally, we have BAFA, or Bank of America Securities, which had an action of maintains its neutral rating currently on Tesla. So that's where we're at right now with that money grab. And of course, it doesn't take a rocket scientist. It could take a rocket dentist to figure out that Tesla's going to go from $600 a share to $650 a share within the next 3 weeks. I could have made that call. I mean, we really don't have a 30-day moving average, folks. We blew right through everything. We're at $600 a share. So we had resistance. Once we got above 600, we saw it fall all the way back down to like $567, $68 and change before it went back up. I think after I was trading right now, it's back up to about $593 a share. So we'll see it continue throughout this week. It will close above 600 this week, and we're going to see that continue to climb from that 625, 650. How high can she fly and still have lift underneath those wings before we lose altitude? That's really the question. Well, that'll be it for tonight. Thanks for watching. I appreciate your support. Now let's go make some money.